You know, it's wild to think about, but the biggest threat to your hard-earned savings, it's usually not inflation. It's not interest rates, and it's definitely not the economy. Actually, it's the person staring right back at you in the mirror. Welcome to this explainer. Today we're diving into the incredibly fascinating and honestly kind of dangerous intersection of human psychology and investment math, all to help you protect and grow your portfolio.
Okay, let's dive into this. It's a brutal reality that pretty much every investor faces at some point. You see a stock trading at, say, 8 times its earnings, and it just looks like an absolute steal, right? The temptation is to buy first, ask questions later. But then, week after week, that supposedly undervalued stock just keeps tanking. Your money is trapped. So why does this happen?
Well, to figure that out, we've got to talk about market emotion. Take a look at this. This 0 represents the absolute bottom of the fear and greed index. When the market hits extreme fear, think back to the 2020 pandemic crash, investors literally just panic. Negative news spreads like wildfire, anxiety spikes, and terrified shareholders end up dumping their assets for way less than they're actually worth.
But then, on the complete flip side, we have extreme greed, hitting right at 100. During a long bull market, this massive positive feedback loop kicks in. Alan Greenspan famously called it irrational exuberance. Basically, people get wildly optimistic. They blindly pile in and totally overpay for stocks, simply because they're chasing those rising prices.
Which brings us to Section 1. Beware the value trap, the illusion of cheap stocks.
So, how do we navigate between these crazy emotional extremes without falling into a trap? Well, Warren Buffett hit the nail on the head. Be fearful when others are greedy, and greedy when others are fearful. It's a legendary quote because it reminds us that true opportunity comes from contrarian thinking. You've got to use the crowd's emotion as a tool to spot mispriced assets, not as a roadmap for what you should be doing.
Now, what's really interesting about this is how it separates the winners from the losers. A genuinely undervalued stock is fundamentally sound, but it's just dealing with some short-term noise. Maybe a temporary supply chain hiccup or a quick industry rotation. But a value trap? That's like a melting ice cube. We're talking shrinking margins, declining revenue, permanent structural headwinds. The stock is cheap because, well, the business is actually dying.
And these traps almost always snare people during massive market overreactions. Research actually shows that as a market ages, whether it's a bull or a bear market, herd behavior just completely takes over. Everyone overreacts to the latest news cycle. But here's the thing, that sets the stage for a sharp correction. The informed investor knows exactly how to capitalize on those swift reversals instead of getting crushed by them.
Moving on to Section 2, calculating true intrinsic value. If we want to avoid getting totally swept up in the emotion of the herd, we have to rely on the mechanical side of investing. And that brings us to Aswath Damodaran's core concept of intrinsic value. In plain English, no academic jargon here, this just means a company is only worth the actual cash it can produce for its owners over its lifetime, adjusted for time and risk. It's what anchors your money in cold, hard reality.
And this brilliantly illustrates that concept. It's the discounted cash flow formula. Now seriously, don't panic at the math here. I know it looks like a lot, but the logic is super straightforward. It just means taking the cash you expect a company to make in the future and adjusting it downwards. Why? Because a dollar tomorrow is simply worth less than a dollar today, and you have to account for risk.
But here's the reality check, and it's a major problem. Most people out there aren't using discounted cash flow. Instead, they rely heavily on the price-to-earnings, or PE ratio, to hunt for so-called cheap stocks. Relying just on PE is incredibly risky. Why? Because it's literally just a snapshot in time. It completely ignores future earnings growth and current interest rates.
Let's look at Section 3, a new metric, the potential payback period, or PPP.
Financial researchers have actually developed a revolutionary evolution that fixes the glaring flaws of traditional metrics like the PE ratio. It's called the potential payback period. Again, I promise the math isn't as scary as it looks. It answers one incredibly powerful question. How many years of discounted future earnings does it actually take to recover the stock price you're paying today?
The real beauty of the PPP framework lies right here in its inputs. It takes that basic PE snapshot and injects it with a dose of reality. You add in G for the company's expected growth rate and R for the discount rate, which factors in real-world interest rates and the specific risk of that stock. Suddenly, you have a dynamic, forward-looking tool.
Let's move to this comparison and see how this builds in the real world. Look at Broadcom. It has a massive, seemingly terrifying PE ratio of 188. Meanwhile, Applied Materials is sitting way down at 22.
Traditional logic screams at you to avoid Broadcom. But wait, because Broadcom is growing at 32%, its potential payback period is identical to Applied Materials. They both sit right around 17 years.
So the takeaway here is absolutely crucial. This framework uncovers what we call the hidden value zone. We're talking about incredible gems, high-growth companies that old-school linear math incorrectly completely dismisses as totally overvalued. By using PPP, you can spot phenomenal businesses with rapid payback potential that traditional metrics would tell you to run away from.
This brings us to Section 4, your margin of safety.
No, let's be totally honest with ourselves for a second. Even with the best math in the world, sometimes we're just wrong. Mistakes happen. Bad luck happens. That's where Benjamin Graham's classic 1934 concept comes in. He was Warren Buffett's mentor, by the way. Think of it like a structural engineer building a bridge. They design it to hold way more weight than it technically needs to, just in case. You have to do the exact same thing with your portfolio.
And that concept is your margin of safety. It's simply the favorable gap between the price you pay today and that calculated intrinsic value we talked about earlier. By paying significantly less than an asset is actually worth, you build yourself a safety net. It gives you room for error and protects your savings from disastrous losses if your estimates turn out to be a little bit off.
So how do we bring this all together into actionable steps to maximize our returns and avoid those devastating value traps? First, look for temporary problems, not permanent secular declines. You want to verify stable revenue and make sure management actually has a solid track record with capital allocation. Wait for clear operational catalysts, and absolutely always insist on a wide margin of safety before you ever hit that buy button.
Finally, Section 5, Investing Smarter with Infoviews.
Ultimately, successful investing is about marrying mechanical valuation with emotional awareness. You can't just be a spreadsheet robot, but you also can't trade purely on your gut feelings. The market is always going to be a wild mirror of human emotion, swinging from extreme panic to extreme euphoria. But the math, the intrinsic value, the PPP, your margin of safety, that's the heavy iron anchor that keeps you grounded.
So, you've got the framework now. You know how to anchor yourself with intrinsic value and protect your wealth when the crowd is losing its mind. The question is, will you step up and master the math, or will you let your own psychology master you?
Let us know your answer down in the comments. If you found this explainer helpful for cutting through all the market noise, please hit that like button, share this with a fellow investor, and definitely subscribe to the Infoviews channel. We've got plenty more deep dive explainers coming your way to help you invest smarter and protect your future. See you next time.